Hello, YouTube. Big tariffs going into effect tonight, having a major impact on the Treasury market, which is the most important market around the world. And so let's find out why. What's going on out here? Listen to the latest on CNBC International.
Market supporter Valerie Tital. Valerie, good morning. Let's talk about the Treasury market. Big moves. Can you just put in context what exactly we are seeing?
Well, frankly, this is the market having a hard time absorbing everybody selling treasuries, but they're selling treasuries not because they're rethinking the Fed, not because they're concerned about inflation. They're selling treasuries because it's their most liquid asset and they're trying to raise cash. This is the first sign of perhaps some further dollar funding strains to come, maybe even later today, later this week. And this is kind of pivotal for the market, because if you think about, if you're a corporate and you've all of a sudden been slapped with these massive tariffs, you have bills to settle, or let's say you're just a corporate in financial strain and you need to do something to protect from bankruptcy. You're selling your most liquid assets in order to raise cash on your balance sheet to defend yourself from that. And what the market is saying right now is it is having a hard time absorbing all of this selling, and that's why we're seeing yields rise across the curve. I mean, it was particularly worrying, the price action in the Asia session and the long end of the U.S. curve. We rose nearly 23 basis points. We blew through 5% in the 30-year bond. And that is not price action you want to see in the world's most liquid market, which many use, frankly, as they use it as a way to hold cash, a way to hold liquidity. We're not seeing that kind of liquidity being offered right now in the Treasury market with these wild swings. I mean, Monday was one of the biggest intraday moves of the 30-year yield this decade.
Yeah, and we're not used, as you say, to seeing moves of this size at that end of the curve. What about the concern in terms of basis trade unwinding? Are we going to have to worry about a repeat of what happened in 2020? This is hedge funds leveraging, essentially a wager the hedge funds make, leveraging between futures and cash trading. That caused a big problem in 2020.
Yes,
the bond market became illiquid. Are we at risk of that again?
Look, what happened in March 2020 is very similar to what we're seeing now, where there is a big risk-off move and there's a dash for cash and you see everybody selling treasuries. That's really what we're seeing right now. The catalyst for the March 2020 move was a failed 30-year bond auction. We've got two auctions this week. Today is the 10-year auction. Tomorrow we got 30-year supply as well. So there's going to be duration for the market to take down. And why we worried about the basis trade is because in some way, the Treasury market has gotten so big. You not only need banks to offer liquidity, think of your normal, Citibank, Bank of America, those kind of trading desks to offer liquidity. You also need hedge funds to offer liquidity as well. And when hedge funds become sellers of treasuries, that's when things get really hairy. And perhaps we're seeing the first jitters of that today. We're also seeing some jitters in funding markets. So that's overnight collateral, general collateral for overnight repo, things like cross-currency basis. We're starting to see jitters of that as well. Now, it's not gotten to dire points yet, but the price action of treasuries is reflecting perhaps that we might see further worries in dollar funding markets.
What about a question of a foreign buyer's strike or foreign buyer's reluctance in these markets as well? Do we have any signs of that?
Look, I think that's a bit far-fetched that people would use the Treasury market as a way to retaliate in terms of selling their holdings. First off, reserve managers normally hold very front-end paper. So we're talking about 2 to 3 year paper. They don't hold longer-term treasuries. And secondly, there's a bigger concern at risk, which is, let's say we have global trade slow down meaningfully. There's just a less demand for people to hold dollars and recycle them into dollar assets in order to facilitate further trade in dollars. And I think that's the more concerning thing right now, rather than worrying about any central banks selling treasuries for retaliation purposes.
Okay, Valerie Tital, our market supporter, thank you very much. And we'll continue to keep you across those market moves in the next hour of Bloomberg Day.
All right. So what's going on? So when you have problems in the Treasury market, the world's most liquid market in supposedly risk-free assets. Ask people if they're really risk-free tonight, while the basically price of them is plummeting because the market is flooded with everybody trying to sell them. That is a serious problem for the world financial system. And when that happens, if it doesn't get resolved quickly, what's going to happen is the Fed is going to have to come in as the buyer of last resort. Either doing QE, quantitative easing, buying up all those extra treasuries to shore up the price and push the yields back down. Or they'll do stealth QE where they say, oh, we're not doing QE, and they just come up with some other program or some other acronym for a facility that they prop up all of a sudden that basically is really QE, but they just call it something else. What does this mean? This means I'm glad I'm in gold. Gold is holding up right now. Tonight, everything is going down. Okay, the dollar's going down. U.S. Treasuries are going down. Stock futures like the Dow and the NASDAQ futures, all that's all going down. S&P futures is going down. What else? Oil's going down. Did I say Bitcoin already? Of course, Bitcoin and all that crap, crypto trash is going down. There's one thing that's going up tonight. You know what that is? Gold. Right now is the time you want to be in gold, okay? Don't get shaken out. There's going to be wild swings. Gold's going to go up. It's going to go down. Gold miners are people going to sell them off like they did the other day. Don't get shaken out. Don't panic. Stay in gold, because on the other end of this, gold's going to be higher. Okay, it's just they go up and down, but in the end, you're going to watch that curve. It's going to be up and to the right. Gold goes higher. Gold miners will eventually go higher as well. There's more inflation coming. There's going to be less demand for treasuries. They're going to have to do QE of some sort. So, gold. They can't print more gold. That's what you want to be in. All right, that's it for tonight's message. Stay tuned for more.